President Trump is angry with the Federal Reserve Bank for refusing to cut interest rates.
We should be the lowest interest rate, and we're not. We're 38, number 38.
He's even called out Jerome Powell, who is the chairman of the Fed.
I told him he's doing a very bad job. He's way late. That's why I call him too late.
But here's the part that a lot of people don't know. The real reason why President Trump is demanding lower interest rates is not so you can get a cheaper mortgage rate or a cheaper car loan rate. It goes a lot deeper than that. That's why in this video, I'm going to show you the real reason why President Trump is demanding lower interest rates, and then I'll show you how this creates an opportunity for you. The Federal Reserve Bank is the central bank in the United States, and they have the power to control interest rates. But when I say interest rates, I'm not talking about your mortgage rate or your car loan rate. The Fed has the power to control the federal funds rate. And the federal funds rate is the interest rate that banks charge each other when they lend each other money. Now, most people look at this and say, when the Federal Reserve Bank cuts interest rates, that means banks get to borrow money at a lower rate so they can charge you less for your mortgage or your car loan or your credit card interest, which is true. But that's not the real reason why the United States government is demanding these lower rates, because it actually impacts the United States government as well. Now, you might be wondering, well, Jaspreet, can't the United States government tell the Federal Reserve Bank what to do? Well, although they're called the Federal Reserve Bank, they're actually not a bank because you and I can't go there to deposit money. They're not a reserve because they're not sitting on any cash reserves, and they're not actually federal because they're not a part of the United States government, which is why the United States government cannot tell the Federal Reserve Bank what to do. But the decisions that the Federal Reserve Bank makes impacts banks, it impacts people like you and me, and it also impacts the United States government. Because when interest rates are higher, yes, it makes your mortgage more expensive, it makes your car loan more expensive, and if you wanted to refinance your mortgage, it's more expensive. And if the Federal Reserve Bank were to lower interest rates, that benefits borrowers, because that means you can get a lower mortgage, you can refinance your 7% mortgage for a 4% mortgage, but it also benefits the United States government because the largest borrower is not you and me, it's not Amazon, it is the United States government, which owes more than $37 trillion of national debt it has to pay back. Now, at first glance, that might feel a little bit weird. Who in the world does the United States government actually owe money to, and do they actually have to pay this money back? And to answer that question, the people that the United States government owes money to is regular people like you and me that have lent money to the United States government. It's to foreign countries like Japan and the United Kingdom and China, which have lent billions and billions of dollars to the United States government. And it's also to the Federal Reserve Bank that has printed a lot of money and lent it to the United States government when they couldn't get money from people like you and me or other countries, because you have the ability to lend money to the United States as an investment. It is called a treasury. And the reason why people lend money to the United States is because the United States always pays their bills. And because of that, it's considered a risk-free investment. That's what every economics book will tell you. And so you lend money to the United States government, and then they give you your money back plus interest. Now, this is where things start to get interesting, and this is also where opportunities start to arise, which is why, a reminder, on August 12th, 2025, I'm hosting my biggest investor workshop of the year, where I'll be going over how you can find better investment opportunities in this changing economy through the Trump policy changes, through the geopolitical tensions, and through the shifts that we're seeing with technology. This is a completely free workshop. This is designed for investors who want to know how to invest your money better, and I'm hosting this workshop twice on August 12th. I'm doing it in the morning at 10:30 a.m. Eastern Time, and I'm also doing it in the evening at 8 p.m. Eastern Time. It's live, but if you're interested in joining, you have to register because we've hit capacity every time we've done this before. So if you'd like to join me on this workshop on August 12th, I would love to host you. All you have to do is click the link down in the description below to register. The United States government saw its national debt explode after the pandemic because of all the spending that the government was doing, from stimulus checks to unemployment checks to PPP loans to free grants for businesses. All these things racked up the United States debt, but during that time, interest rates were at their lowest levels in history. Today, interest rates are a whole lot higher, which means that the United States government borrowed a whole lot more dollars, and now they're paying a lot more interest on those more dollars, which is why the fastest growing expense for the United States government is not the military, it's not healthcare, it's not infrastructure, it is national debt interest payments. Now, you might hear that and say, oh, well, that's just the government's problem. Well, actually, no. It's your problem. See, the way that the United States government works is that they have one source of income, and that source of income is tax dollars from taxpayers, and then they generate these tax dollars and then they spend money. Now, what we've seen happen is that the United States government has been spending more money that they're generating from taxes, which is why we have this $37 trillion worth of debt. And so they supplement this spending with debt because the tax dollars are not enough. Now, you might be wondering, well, where's the United States government actually getting these tax dollars? Let me show you. As a licensed attorney who's not your attorney, here's a small list of taxes that you might be paying. Number one is your income tax. You go to work and you get paid, you have to pay taxes on the money that you make. Number two are your payroll taxes. This is your FICA taxes, your Social Security taxes. Number three are your capital gains taxes. If you buy a stock and you sell it for a profit a few years later, you have to pay taxes on that growth of your investment that you sold. Number four are your sales taxes. You go to the store and you buy some stuff, you're gonna pay sales taxes on the things that you buy. Number five are estate taxes. This right now is primarily just for wealthy people, but let's assume that you die and you have a fortune that you then pass down to your kids. Well, you have to pay taxes when that money goes down. Number six is the tariff tax. We've been hearing about this all over the news. Number seven is property taxes. You buy a house, well, you have to pay taxes on that house every single year. Number eight are corporate taxes. Corporations, when they make a profit, they have to pay a tax on that profit, separate from everything else. Number nine are state and local taxes. Certain cities, certain states are gonna have their own tax they charge. And then number 10 are other. I just kind of lumped everything else here. Otherwise, this video would turn into all the different types of taxes that you pay. But this could be things like toll taxes or cigarette taxes or alcohol taxes and everything else. So you pay taxes like I just showed you, and that is revenue for the government. And then the government goes out and they spend money. The problem is the government is spending more money than they're generating from taxes, and so they supplement this spending through that debt. In 2025, it is estimated that the United States government is going to generate $5.2 trillion in tax revenue. However, we will have a deficit of around $1.9 trillion. This is the expectation. We obviously don't know for sure what's going to happen in 2025 just yet, but that's an additional $1.9 trillion in debt. Why does this matter? Because we are growing this national debt value right here, while interest rates are still high. Now you can start to see how things start to get pieced together. Because if interest rates are high, the government is growing how much debt they have, and they already have so much debt, that means more of your tax dollars are being used not to fund infrastructure projects, not to fund healthcare projects, not to fund the military, not to fund more services for you, but your tax dollars are being used to pay back this national debt because this is the fastest growing expense. And this is where President Trump is saying, if we can lower interest rates by, let's just say 1%, well, 1% of $37 trillion is $370 billion. But there's a pro and a con to cutting interest rates. That pro is obviously number one, this debt cost can go down because then the United States government can refinance their debts, and new debts become cheaper because you can borrow that debt at a lower interest rate. But the con to that is when you lower interest rates, you are encouraged to borrow more money. Because when it's cheaper to borrow money, we've seen people go out and buy bigger houses, buy bigger cars, spend more on their credit card, or the United States government could also potentially borrow more money because, well, you have the ability to do so. So lower interest rates don't always encourage smart spending. It could be good in isolation, in theory, because if we lower interest rates and then we were able to pay back this debt cheaper, that would be good, assuming that we don't go out and borrow more money. The problem that we're seeing right now is that the United States government keeps spending money that they don't have. That has been an ongoing kind of theme for the United States government for decades, that we don't believe in a balanced budget. We make money, we spend money, but the numbers don't really matter. We're just going to spend whatever we want to do. Now you might say, well, this seems like a simple solution. Either we raise taxes or we cut our spending. The problem with that is people don't like either of those two things when you actually implement them. If we were to raise taxes, I mean, you can imagine how angry people would be because nobody likes to pay taxes. I mean, people don't like the feeling of money leaving their paycheck going to the United States government. If you like paying taxes, you can just go onto Uncle Sam's website and Venmo them money. Because yes, now you can Venmo the government if you feel like you want to make a donation to them. Or we could cut expenses, which also people don't like, because when you cut government expenses, that means people make less money. Because remember, this government spending means it's money going into the hands of people's pockets. This could be people's salaries. This could mean contracts for contractor companies. This could mean contracts for infrastructure. This could mean contracts for engineering companies. This could mean contracts for tech companies. And so if the government were to spend less money, that means people have less jobs, which could also impact the economy, because that means less money is entering the economic system. And you can start to see that conundrum, because cutting spending has a cost. Raising taxes has a cost. And we want to live in an economy where, hey, I don't have to pay taxes and the government keeps stimulating the economy, but we can't keep living in a fairy tale la-la land forever. Eventually there's a price to pay, and there is. This is now what happens when the government keeps spending money that they don't have. You start to see the value of your dollar go down, because our dollars, our paper currency, is not backed by a precious metal, it's just paper. So when the government keeps borrowing more money, they have to keep going back to the Federal Reserve Bank. And remember what I said a couple minutes ago, the Federal Reserve Bank is not sitting on any cash reserves. When they lend money to the United States government, the Federal Reserve Bank has to print this money out of thin air. So when the Federal Reserve Bank starts printing money and they give it to the government, more money gets created, which means the value of each individual dollar goes down, causing the prices of things to go up. Because the Federal Reserve Bank can't print wealth. They can print dollars, they can print currency. And so if we're just increasing the number of units of currency that we have, we're just increasing how many dollars there are, the value of each dollar sitting in your savings account is dropping, while the value of your salary is also going down, which is why the prices of things go up. This is what inflation is. Inflation comes from the word inflate. And what are we inflating? We're inflating the monetary supply. We're inflating how many dollars are out there. And when you do that, things become more expensive. And the average person who doesn't understand this becomes poorer, because now your savings are worth less, your salary is worth less, and the average person's salary hasn't kept up with inflation over the last 5 decades, while investors become wealthier. This is why I want you to understand this, because all of this is what's happening in our economic system. This system is probably not going to change anytime soon. However, over the last number of decades, as this system has played out, what we've seen is that investors have become wealthier because of this. And there are certain things that you can do to benefit from the way that the system is. The first and probably the simplest thing is, if the United States government has to pay out higher interest rates because of the Fed's higher interest rates, you could just lend your money to the United States government and take advantage of these higher interest rates. Now, you could lend your money directly to the United States government, which has a few extra steps, or you could just invest your money into a short-term treasury ETF. Now, full disclaimer, I can't tell you what to invest in. I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But take a look at this. SGOV is an ETF. You can buy this on really any stock brokerage account out there, and what you'll see is that the price of this stock doesn't really change because it's backed by United States treasuries, meaning the United States government. The only time the stock price changes is when they pay out this dividend. And this dividend is your interest payment that you get from the United States government. So it's very predictable. It happens every month. And at the time I'm recording this video, they're paying out around a 4.5% dividend a year, meaning 4.5% interest payment a year, just for owning this ETF. And the other benefit of that is that because it is associated with treasuries, meaning lending money to the United States government, the income that you generate from that interest payment is not subject to local and state taxes generally. Now, it is not FDIC insured, but it is backed by the United States government, and we know that the government will always pay their bills because the government can just work with the Federal Reserve Bank to print more money to pay their bills. Now, that doesn't mean that the value of the dollar is not going to go down. That's the real risk. The real risk is not that the government is going to not make their bills. The real risk is that the government is going to keep printing money to pay their bills, which hurts the value of the currency. But that's one way to think about it. And the other risk is, of course, if the Federal Reserve Bank starts cutting interest rates, the interest rate that you would get from this ETF would also fall. Beyond that, if you wanted to invest in investments, say stocks or real estate, what we have seen throughout history is that investment values go up. And one of the reasons why is because inflation benefits stocks, inflation benefits real estate. I mean, just take a look at how housing prices have grown over the last 50 years. Take a look at how rent prices have changed over the last 50 years. Take a look at how the S&P 500 has grown over the last 50 years. Yes, we've seen a growth in the economy, but we've also seen inflation disproportionately benefit asset values, which is why you want to be an investor to take advantage of how this economic system works. Now, I don't know where interest rates are going to go. I don't know what the Federal Reserve Bank is going to do in September. I don't know what the Federal Reserve Bank is going to do for the rest of 2025. We know that Jerome Powell might get kicked out of the Federal Reserve Bank in 2026, and we know that President Trump probably will want to replace him with somebody who's going to want to cut interest rates very aggressively. So all of those things can impact the government, but I want you to understand now how interest rates play a broader part in our economy besides just your mortgage rate, besides just your car loan rate, because it really impacts the United States government and their ability to spend money on other projects, because if the United States government now is spending so much of their income on interest payments, well, it's something you should think about, because you're the one that's funding the United States government, and you want your tax dollars to be benefiting you, not just paying back what the government spent their money on last year or 10 years ago. So this is what you want to pay attention to. Again, for those of you that are investors and you want to stay on top of how you can find investment opportunities for the rest of the year, I encourage you to join me on my investor workshop on August 12th. Again, I have the link for you down in the description. America is entering a debt-death spiral.
When debts rise relative to incomes on a chronic basis, right now for the U.S. government, it's almost $1 trillion a year that goes to interest payments. When you run a large deficit, you have to sell debt to do that. And when I calculate it, the quantity of debt sold to be sold is much